All right, I see 4:15.
All right, let's do it.
Good luck.
Thank you.
Good afternoon. My name is Joe Bacella, Director of Client Success here at Chaikin Analytics, and I'd like to welcome you to Conquer Earnings Season and Profit from Earnings Surprises. Presenting today is Mark Chaikin, founder and CEO of Chaikin Analytics. Mark created the Chaikin Power Gauge Rating, a proven 20-factor model that uniquely combines fundamental and technical factors. This webinar is being recorded and a copy will be sent to all registrants. Please submit your questions throughout this session using the GoToWebinar chat window. To get right into it, here's Mark Chaikin.
Thank you, Joe, and welcome everybody. This webinar is special for me because so many of our subscribers have asked us to add earnings dates and earnings alerts to Chaikin Analytics, and we did it in the release that came out at the end of February. So this is hot off the presses, if you will, Conquer Earnings Season with the new Chaikin Analytics earnings features. A little bit about my background for those of you who don't know me. 50 years on Wall Street. I've survived 10 bear markets. Up until February 11th, it looked like that experience might be relevant, but we've had a pretty decent rally since then, even though you hear a lot of people on CNBC talking as if it's a given that we're in a bear market. I don't think that's the case. For 45 years, I've been using technical analysis along with fundamentals. The reason is the first bear market I ever experienced in 1969-70 wiped out over 70% of my clients' portfolios, and I vowed that would never happen again. Along the way, I've been mentored by some of the smartest, most successful institutional investors, and the reason that's relevant to today's webinar is that everything I learned from them is embodied in the Chaikin Power Gauge Rating, our 20-factor quantitative model. It's the culmination of my life's work, and it's my pleasure to share it with you to show you how you can make money in earnings season and beyond. We've been fortunate that we've been quoted on CNBC.com, appeared on Fox Business and CNBC, have written for Nasdaq and Forbes. And most importantly, Barron's reviewed our product 3.5 weeks ago in their electronic investor column and called it one of the 2 best quantitative sites on the internet. So we're very proud and pleased that what we've built and what you've been using, if you're a Chaikin subscriber, or what you're going to see if you're not, is working. So the biggest problem we have in our personal lives and in the stock market is information overload. We're living in the age of distraction. So the key is, how do you focus, whether you're a trader, whether you're a swing trader and investing for your 401k plan, whether you've got an advisor or you're managing your own funds, how do you stay focused in this 24/7 news cycle, not just in the stock market, but in your personal lives, Facebook, LinkedIn, your email accounts? This webinar is all about focus because it's the only way you can make money in the stock market. As I said, whether you're an options trader, a swing trader, or investing in your 401k plan, you've got to stay focused, look at the right information and not too much information. So if the problem is information overload, the solution is Chaikin Analytics. We've combined everything you need to know about a stock or your portfolio or future opportunities in one neat package. You can get everything you need, and this earnings functionality that we've added to Chaikin Analytics in response to client feedback is just the cherry on the sundae, but we're going to keep adding to it. We've added 4 significant pieces of functionality in the last 4 months to Chaikin Analytics, and it doesn't stop with the earnings module. I've got a very sensitive mouse. I'm just going to use the buttons. So how does Chaikin Analytics lead to profits in your trading and investing? It does that because it gives you a directional edge. I ran an options department for 5 years at a firm called Tucker Anthony, which is a great regional firm. And what I saw was people losing money right and left in options trading. And the same would be true for swing traders because they didn't have an edge. Now, Chaikin Analytics gives you an edge because our quantitative model, the Chaikin Power Gauge rating, combines fundamentals and technicals. So we do the heavy lifting on the fundamentals. It's important to realize that fundamentals drive stock prices. Big institutional investors at Fidelity, T. Rowe Price, Invesco, the big hedge funds, primarily use fundamental analysis. Some money is run using quantitative models, which is why what we've accomplished is so important, because there are people using models to run money based on computer-driven, rules-based methodologies, and we're doing that as well now. In addition to analyzing the fundamentals and the technical in a quantitative model, we have 6 pairs of buy and sell signals to give you better entries and exits. And all of this gives you a directional edge. So in today's webinar, you're going to learn 5 steps to conquering earnings season, because earnings season for a lot of people is very daunting. And you'll see in the next slide what earnings season is really all about. So in this webinar, you're going to find out how to find bullish and bearish stocks using the power gauge rating, how to use Chaikin Money Flow to predict future price movements, exit stocks at highs and lows occasionally. You're going to learn how to dramatically improve your timing with buy and sell signals, how to play good defense. I can't stress how important that is. So much attention is focused on finding the next big winner, and not enough attention is focused on cutting your losses and getting stocks out of your portfolio that could potentially destroy your hard work and all the good returns you've achieved. And then finally, we're going to look at the new earnings functionality in Chaikin Analytics and how you can use it to supercharge your profit season and beyond. So before we get into the Chaikin Power Gauge rating and the earnings functionality and some examples, both past and present, about how to use it in earnings season, I'd like to focus on the market for 1 second. It's on everybody's mind. It's really important to have a sense of what the market's doing and where it's been. So let's look at a 1-year chart of the SPDR, the S&P 500 ETF. It's the most actively traded trading instrument, and a lot of people use this to make a directional bet on the market, either up or down. Some people use it instead of mutual funds to just get broad exposure to large cap stocks. The key here is that all through the spring, the market was having trouble getting through the 2100, 2130 area. And then on August 24th, we experienced what I call Market Order Monday. The stock index futures were down 1,000 points overnight. That's the Dow Jones futures. And a lot of people panicked and put in market sell orders. So we got a very big waterfall decline back in August. Heavy volume. Negative Chaikin Money Flow. Chaikin Money Flow measures institutional buying and selling. I introduced this technical indicator back in 1982. It's been used by both individuals and institutional investors ever since. So what happened after that first waterfall decline? Well, you had a rally up to form the middle of what's known as a W pattern. Stocks basically bottom out in 2 ways. V-shaped bottoms, which means they sell off and immediately rally and keep going up. And that's what we had between October of 2011 and April of 2015. That's why you kept hearing on CNBC, buy the dips. Well, in August, the world changed a bit. Whole series of news events that were used as an excuse for why the market went down. Price of oil, China. Could have been Disney reporting a negative surprise that people really felt came out of the blue about ESPN subscriptions falling off. But in any event, you got that big rally up. You went from 1870 on the S&P to above 2,000. And look at the Chaikin Money Flow in that red box in the middle of the chart. It stayed red, not green, meaning it didn't go above the 0 line. That said that the institutions were not participating in that rally. So then we came back down in September, and in the cash S&P index, we actually equaled the previous low in the futures because you had that panic, and in the SPDR, we didn't. But we formed the right side of the W, and look what happens when you rally out of that. You started picking up money flow. Strong rally. which continued well into November. Then we had a pattern very similar to what we experienced in the spring, where the market had trouble getting through 2100. Series of relative strength sell signals, one of our 6 pairs. Money flow went negative, and then another waterfall decline on heavy volume. But the difference is that on the rally off the January low, now remember, once the Fed started raising interest rates on December 15th, the market basically started selling off. And the rally that ensued from that January bottom was a lot different from the rally in September. Why? Because you were picking up positive money flow. The institutions were now buying into the rally. So that when we came back down and equaled the previous low at 1812 on the S&P cash index, or 181.20 roughly on the spider, Chaikin Money Flow was positive, and it's picked up steam as we've headed back through resistance at 1950 up to the 2000 level again. And why is the 2000 level important? Because that's where the market broke down not once but twice. It broke down in September from that level, and it broke down in late December. So very critical level, and we got a little profit taking today. It's the first down day in 5 days, and it was overdue, but it was also stimulated by the price of crude oil, which had rallied very dramatically up to the $39 level, almost 40 yesterday. Crude oil was down 4% today. Now on the top of this chart is something very proprietary to Chaikin Analytics. We call it our power bar. Do you see the numbers 87, 324, and 74? If you do, please type a Y into the question box so that I can get a sense that you're seeing what I'm seeing on the chart. Well, we see a lot of people who do see that. So what is the Chaikin Power Bar? Well, it's a very important indicator. It tells you the number of stocks in any list or index or industry group or ETF that have bullish versus bearish power gauge ratings. And in the last 3 days, for the first time since April, there are more stocks in the S&P 500 with bullish ratings than bearish ratings in our 20-factor model. That's really important because that gives me the confidence to tell our subscribers that this is a time when you should be buying dips. Market sells off for 1.5 to 3 days, maybe back down to 1950, maybe not that much. That's a great time to be coming into the market on the long side. So having analyzed the market, my bottom line conclusion is there's no evidence of a bear market. Could there be a bear market in the offing? Of course there could, but the people who want to get on CNBC get on there because they have extreme opinions very often, and so they'll find the bears and they'll trot them out. You've got to focus and filter out the headlines. So now let's get into what's good about Chaikin. This webinar is about earnings season and the new earnings functionality that can help you cope with it and actually make money during earnings season instead of be fearful of it. Now, earnings season is typically defined as the period that begins in the first week or so of January, April, July, and October. These are for companies that report on a calendar year basis. So we just finished the January earnings season in mid-February, and April earnings season, when companies will report their first quarter earnings, begins on April 11th, on Monday, when Alcoa reports, and then it extends for 6 weeks. So 24 weeks of the year, you've got a lot of companies reporting earnings, and there's a lot of volatility in stock prices surrounding earnings report. And that's what spooks a lot of traders and investors. A lot of people, as I go around, say, well, I like to get out of a stock before they're going to report earnings. Well, we're going to show you why you don't have to do that unless the Chaikin Power Gauge is knocking you on the head saying you must do it. There's a lot of speculation in the media about future earnings reports in CNBC and Fox Business, Bloomberg. They're constantly chattering about what a company is likely to report. Will they surprise to the upside? Will they disappoint, and so forth? That contributes to the volatility. It's also a huge distraction. That's why I said in the age of distraction, you've got to have the tools that enable you to focus. So it's really important to know with some degree of reliability whether a stock is likely to meet, beat, or disappoint when they report their earnings in April. Now, in volatile markets, you need a disciplined methodology. Otherwise, you're going to get tossed like a leaf in a hurricane, from bullish to bearish, from fearful to greedy. You need a discipline you believe in, and you've got to use that discipline day in and day out. Consistency is the key to making money in the stock market, whether you're a trader or an investor. If you've got a methodology you believe in and you consistently apply it without second guessing it, you can make money in volatile markets and in trending markets and in sideways markets. So we've created this pyramid that encapsulates the Chaikin methodology. Some people are now calling it the Chaikin way. That sounds a little too new age for me, although I do believe in meditation. But whatever you want to call it, at the top of the pyramid, Chaikin power gauge rating. Deceptively simple, as you'll see, but very powerful. Tells you on a scale from very bearish to very bullish whether any one of 5,000 U.S. equities has the potential to outperform or underperform. We also believe in industry group strength as another way to get an edge, but we're not going to address that in this webinar. We've talked about it in previous webinars. I want to really focus, again, the whole key is focus on the new earnings functionality and how you can use that to make money during earnings season. At the bottom of the pyramid are two only technical indicators. You don't have to look at 20 different indicators. In fact, if you do, you're doomed to what's known as analysis paralysis. So Chaikin relative strength is a unique way to look at how a stock is performing relative to the market. And Chaikin Money Flow, as we've said, has been in the marketplace for 35 years, helping investors make money by measuring institutional buying and selling. We'll see some examples of that very shortly. Chaikin buy and sell signals, the sweet spot right in the middle, because timing is everything if you're an options trader. And even if you're an investor, if you buy a stock at the wrong time and watch it go down 15%, it's going to test your will. And we're going to see examples of that and some ways that you can avoid that. So timing is really critical. Chaikin power gauge rating, what is it? It's a 20-factor model that's been proven since January of 2011, when it first became commercially available through research reports on 5,000 stocks that are updated nightly, to find the stocks that are likely to outperform the market or underperform the market. Now, the display, as we've said, is very simple. It looks like the gas gauge on your car, doesn't it? But don't confuse simple with simplistic, because under the hood, and I like to say that the Chaikin power gauge is like a Chevrolet with a Ferrari engine under the hood, there's a very powerful 20-factor model. It can be your GPS during earnings season. So let me ask you a question. How many of you are reluctant to trade during earnings season? If you are, type a big R in the question box. And Joe, let me know in a minute, in about 30 seconds, what people are saying. Well, I can actually see myself that a lot of people are nervous during earnings season, and with good reason. Stocks spike up, they spike down. You need an edge, and the power gauge rating can be your GPS during earnings season. And the reason is it's a 20 into 4 components, and it works because it's built on the factors that institutional investors look at every day to make their decision. It works because this is the way Wall Street works. And this is what I learned from my institutional clients when I had my own institutional brokerage firm. This is what I learned from people that I work with who were a heck of a lot smarter and more experienced than I were. These factors drive the market because institutional investors rely on them. So the big caveat here is not every investor looks at all of these indicators because there are different styles of investing. So value investors like a Warren Buffett would look at financial metrics. These are the bedrock of our 5% fundamental and only 15% technical. But by the way, the technicals keep the model honest because the real world is very important, as we'll see in a moment. Earnings factors, very critical. It's what Jim Cramer and the whole CNBC crowd focus on. And I've boxed in red a factor that we call earnings surprise, very relevant for today's webinar. So what is an earnings surprise? An earnings surprise happens when a company reports better than expected earnings or worse than expected earnings. And Wall Street is pretty harsh in almost all types of markets to companies that disappoint. Surprise to the upside, as long as the market isn't in a real serious downtrend, will tend to do very, very well. But the real key here is the concept that I learned from a gentleman named George Douglas at Drexel Burnham, who built one of the finest quantitative databases on Wall Street. And George did the original research on earnings surprise and earnings estimate revisions. Because the reality is that on Wall Street, if a company reports better than expected earnings, analysts at the major brokerage firms will raise their estimates, unless the company is guided lower, which is sort of a hidden hand grenade that sometimes comes in the conference call that goes along with the earnings. But in general, if a company reports better than expected earnings, analysts will start raising their estimates. Now, Wall Street analysts are just like everyone else, just like you and me. Some of them are very, very smart. Some of them are lazy. And everybody is zeroed in on the one or two analysts in any given stock that really know it better than anyone else. So if they raise their estimates, the rest of the analysts will sort of pass their hand over it like a magic wand and raise their estimates as well. And then Wall Street salesmen start calling their institutional clients, talking about how their analysts have raised the estimates. What are they doing? They're looking for orders. That's how they get paid. And that's the way Wall Street works. Research that was done by Standard & Poor's has shown that analyst earnings estimate revisions are the single biggest short-term driver of stock price movement. That's why this whole suite of earnings functionality that we've introduced is so important. And then the third factor in the expert opinion category, which looks at what analysts are doing, are what we call changes in analyst ratings. So very often, an earnings surprise will lead an analyst to go from neutral to bullish or neutral to bearish on a stock if it's a bearish earnings surprise. Those three factors constitute 15% of the model. Now, it's not all weighted equally. And in addition to that, we look at insider buying, which is very important because insiders know more about their company, obviously, than anyone else. So when they take their checkbooks out and buy their own stock, that has a bullish impact on the power gauge rating. And then finally, short seller, short interest is something I'd like to single out. The short sellers are the smartest people on Wall Street. They do a lot of good research. Their mission is to find companies that are overvalued using aggressive accounting techniques. We'll show you a couple of examples of that in the webinar. So this model is eclectic. It finds a lot of different ways to like or not like a stock. So it's not religious like a Warren Buffett who says he only buys value stocks, or Graham and Dodd who said you have to buy a dollar's worth of assets for 50 cents. And it's not an earnings momentum model. It's a combination of all of them. And as you'll see in the examples, it can be bullish on a very conservative stock, like a utility, or it can be bullish on a very aggressive stock. Same on the bearish side. So how's the performance been? Nice to talk about it, but does it work? Well, this is a chart of the performance using the Russell 3000 as our index benchmark, starting in 1999, going through the present. Some of these are simulated results. Those are always good. Nobody ever presents a webinar and says, I've got a model that isn't working very well, but it's going to start working soon. But it also includes 5 years of real-time results. The average very bullish stock since 1999 has been up almost 20% a year. And the average very bearish stock has been down 1%. 6.5-year bull market, almost a 7-year bull market now. But let's look at what happened in 2015. In 2015, with Energy Week and Small Caps Week, the very bearish stocks in the Russell 3000 were down 17%. Those are the stocks you needed to avoid. That's where playing defense comes in. Chaikin Power Gauge is the best tool I know to tell you which stocks are likely to be down and get into that very bearish bucket. down 17%. The very bullish stocks were down 1%. The spread is still wide. It's that ability to differentiate between very bullish and very bearish stocks that makes the power gauge so important, especially during earnings season. Now, two other proof points. We've got a partnership with Nasdaq that started in April of 2014, where we created 3 Nasdaq Chaikin power indexes. They're quotable every second on Yahoo Finance or Google Finance or Bloomberg. All 3 of the Nasdaq Chaikin indexes, which rely on the power gauge as their final filter, have outperformed their benchmarks. So what does that mean? Well, if you're in the market in your 401k plan, do you want to do better than the S&P or worse than the S&P? I think the answer for everybody would be we'd like to outperform the S&P. Nobody likes average. America is about exceptionalism. I believe that wholeheartedly. And then Nasdaq introduced us to a company called First Trust Portfolios, which is the largest creator of unit investment trusts, and they also create ETFs. And on December 7th, after an 18-month due diligence period, First Trust rolled out the Chaikin Low Beta Growth Portfolio Unit Investment Trust Series 1. It just closed its selling period. This portfolio is a buy and hold portfolio. Have to hold it for 15 months, so you can't take losses, take profits. It's really proven the value of the power gauge rating because in the first 3 months, it's outperformed the S&P by over 200 basis points. That performance, if you could annualize it, which would be very nice, but can't promise that, would mean that the unit investment trust would outperform the S&P by 800 basis points. So what does that mean? If the S&P is up 5%, portfolio would be up 13%. Are we promising that? No, but could it happen? Yes. Now, First Trust believes in this so much that they've launched a Series 2 as of Friday. Another trust, some of the names are the same, some are different. We'll see some of the examples in the webinar. So proof points from very, very important partners who did a lot of due diligence to support the Chaikin power gauge rating. So the first step in prospering during earnings season is to identify what we call classic Chaikin bulls and classic Chaikin bears. Classic Chaikin bull is a stock that has a bullish Chaikin power gauge rating, which means that the fundamentals can support an up move in price. That's outperforming the market. Very critical if you're picking stocks to trade or to invest, to focus on the concept of relative strength, and we'll get into that in a minute. It's the first research I ever did in 1966-67. And then we look for Chaikin Money Flow to be strong, indicating that the institutions are buying, not selling the stock. So here's a one-year chart of a gas distribution utility called Atmos Energy. And notice at the bottom of the chart that the power gauge was bullish in March and April of 15, but the stock was underperforming the market. How do we know that? Well, the power gauge is at the bottom. It can be red, yellow, or green. And right above it is the relative strength of the stock to the S&P 500 over the last 6 months. Now, in mid-July, the power gauge turned bullish after being neutral for 4 months. And a couple of days later, the stock started outperforming the market. It broke out of this little base, tested it, and it's been pretty much straight up ever since because the market has been defensive. And when the market is on the defensive, they buy utilities, they buy food stocks, electric utilities, gas utilities. One of our signals kicked in. We call this an oversold buy signal. It kicked in about a week and a half ago, and the stock was trading at around 68.50, and now it's moved up to 71 in a market that's now running into resistance. So this is an example of a classic Chaikin bull, and the Chaikin money flow was very positive. Institutions have been buying this stock since late July. How do we know that? Because in that 6-month period, the power gauge rating has been mostly bullish. It's been the Chaikin money flow rather. It's been mostly green. So it's both visual and mathematical. Now here's a classic bear, and these are the stocks you really have to identify and avoid. Kinder Morgan is our poster child. Bearish power gauge rating, weak performance relative to the market, and weak Chaikin Money Flow telling you that the institutions are selling the stock, not buying it. Now, how many people on this webinar were seduced by the 20% yield in Kinder Morgan back in the spring of 2015? If you are, I'm not going to ask you to raise your hand, but had you been using something like Chaikin, an objective third-party research tool that has a proven track record of identifying stocks like Kinder Morgan that are about to implode, you could have avoided a lot of pain, because the reality is that that dividend yield has dropped from 20% to 2.5%. And although Warren Buffett is now buying this, as are a number of hedge funds, it's by no means out of the woods, because very dependent on the price of crude oil. Crude oil has done quite well, but nobody really knows if we've made a bottom in crude oil. I wish I did, because if you did, you'd have a good clue as to what the stock market was going to do, because we're tied at the hip to the price of oil. The big rally we've seen in the last 4 days was tied to the price of crude oil getting up near $40 a barrel again. Today's decline, you could call it profit taking. You could say, well, with crude oil down 4%, the energy stocks were down over 4%. The energy ETF, the XLE, was down 4.5%. Maybe that's why the market was down. But the bottom line is Kinder Morgan is a stock that you want to try and sidestep and avoid. If it's in your portfolio, Chaikin's going to give you an alert saying bearish power gauge rating, rethink your opinion on the stock. Now, how do you find these stocks? Very nice to have a rating system. Well, we've got a list manager for both our iPad and our desktop app, which makes it very easy to find these stocks. We have something called Chaikin Hot Lists, and one of the categories is Power Gauge Hot Lists, so you can find all the bullish stocks. You can find the stocks that turned bullish this week and so forth. And as you'll see, we've also introduced a powerful stock screener where you can filter down hundreds of names, thousands of names, down to just a precious few that demand your attention. Again, the whole concept of focus in just seconds, using any of the factors in the power gauge rating, as we'll see, and a lot of other juicy stuff. So we've identified a pattern that we call the dynamic duo. It's that combination of a bullish power gauge rating, which says the fundamental factors are lined up positively for this stock, and Chaikin relative strength, which says that the stock is outperforming the market. So the dynamic duo finds big winners and losers. And superior returns come from stocks that outperform the market. There's one caveat, however. Relative strength, which is the first technical indicator I ever researched, stands alone as a bullish or bearish indicator. Now, what do I mean by that? Well, we're going to see a chart of Amazon in a few minutes, and Amazon had its power gauge rating go bearish in mid-January, but for about 10 months, Amazon, with a neutral power gauge rating, was just a dynamo. It was outperforming the market, and so the relative strength indicator was used by a lot of our subscribers who are momentum traders and don't care about the fundamentals. Although the more they use Chaikin, the more they learn how the fundamentals do impact stock price movements. Relative strength stands alone as a bullish or bearish indicator. So let's look at a couple of examples. The first two are going to be in the solar energy group. Now, solar is very popular right now. Renewable energy is an answer to the domination in the Middle Eastern countries and price of oil. And First Solar is arguably the blue chip in the group. Very little debt, less than 300 million, a lot of cash on the balance sheet. They actually make money, which is unusual in solar. And this stock had a bullish power gauge rating in August after some bearish period. And here we see the first example of our new functionality. This is a one-year chart of First Solar from our desktop app. Look at the top, and you'll see the next time this company reports earnings. Thursday, May 5th. Very important to have a heads up well in advance of earnings. And it's telling you what the estimate is. Now you could, as we'll see later, mouse over that and get more detail. And on the chart in red and green are alerts to the previous 4 times that First Solar reported earnings. So notice that in May, at the left-hand side of the report, the chart, the EPS icon is red, which means that First Solar reported a negative earnings surprise. That caused analysts to start lowering their estimates. Look at the institutional selling that followed that, and the power gauge rating went bearish. Then in August of 2015, First Solar surprised to the upside. Positive earnings surprise, it gapped up, went from 43 all the way to 50 on the opening the next day. But because we were in that W-shaped bottom, August 24th came along 2 weeks later, First Solar sold back down and tested its previous lows. But then when the market picked up steam, excuse me, First Solar started to really power ahead. And in early November, it started outperforming the market at a price of around 55. Came out with another positive earnings report, and some traders use that as an excuse to take profits. But the pullback was 5 days long, and then the stock went and made another new high. And then you see a big spike on the chart. Look at the money flow, by the way. Everything's lining up here. Power gauge ratings bullish. Relative strength is strong, so the market is agreeing with the model. That's what we call the dynamic duo. And Chaikin Money Flow is telling you that the institutions are buying this stock whenever they can. Now, in late December, Goldman Sachs recommended this stock. It was trading at 65. It had just made a new high. And they put a price target of $100 a share on it. And the stock spiked up from 65 to 72 the next morning. And then because the market was selling off, it dropped from 72 all the way to 57. And that can really test your mettle. That's why I say timing is so important. If you bought that stock on the spike at 72, instead of having bought it when the power gauge turned bullish or on any of the previous dips, emotionally you were put to the test. And how many of you have experienced those sleepless nights when you wonder whether there's been a mistake that you've made in buying a stock at the wrong price? If you have, put 3 S's for sleepless in the question box, because if you have, you've experienced a lot of what I experienced before I created the Chaikin Power Gauge rating. And I see that a lot of people lose sleep. And by the way, losing sleep is probably the worst thing you can do as a trader, because you need your wits about you and you need your energy if you're trading the markets. If you're an investor, who wants to lose sleep? It's damaging for your health. Anxiety is the biggest killer in America. So use the power gauge rating as your guide. And look at what happened toward the right-hand side of the chart. In February, we got a buy signal. We call it a money flow buy. And 2 days later, the stock reported earnings. And yet again, it gapped up and made another new high. Now, this is a volatile stock. So today it was down 3%. These upper volatility bands are a wonderful place to take profits. We get asked every day, how do we know when to sell? Well, it depends whether you're a trader or an investor. It depends what your time horizon is. But it never hurts to take a partial profit at an upper volatility band, particularly when the market is at a resistance level. So here's an example of a very strong dynamic duo. In the same industry, Sun Edison has been a disaster. Dynamic duo has been weak. What does that mean? Power gauge rating has been bearish and the stock has been underperforming the market. And when did all that take place? It took place back in mid-July when the power gauge rating went bearish, and then about 2 weeks later the stock started underperforming the market, and then about 4 days after that, guess what? Negative earnings surprise. And then a little bit of a rally, some sell signals, another negative earnings surprise back in November. So here's a stock where the patterns keep repeating as they do in Wall Street. Now, I want you to look at the left side of the chart because that illustrates my concept that relative strength stands alone as a technical indicator. Notice how the power gauge was neutral, but the stock was outperforming the market, and even a negative earnings surprise didn't stop the momentum traders. But just be aware that if you're trading a stock like this, or Amazon, or Netflix, where the valuations are extreme, or where it's a favorite concept of Wall Street, that as soon as something changes, that high wire you're on without a safety net is going to prove fatal. And that's what happened to SunEdison. SunEdison dropped from 28 when the power gauge turned bearish all the way to $1. Merrill Lynch put out a sell recommendation 3 weeks ago at $3 a share. That's why you can't depend on Wall Street, you can't depend on the media. You've got to have an independent third-party, objective research capability. Whatever you use as your primary capability, we'd like to think that the power gauge could be that, but we know that many people use newsletters or watch CNBC or follow brokerage firm research. The power gauge will keep you honest because it's 20 factors, objective, updated every night. Now, we got this testimonial just the other day. If I had Chaikin, I bought SunEdison. Chaikin rated it poorly and it went down. If I had Chaikin then, I would have bought First Solar instead. Rich C is a new subscriber and saw the light when he saw the charts. And you can as well. Now, another concept that's really critical is spotting personality changes. It's really the key to making and keeping profits because stocks change character just like SunEdison did. And your biggest nightmare as a trader or an investor is to be on the wrong side of that door when Jack Nicholson is coming through with the axe. So how do you spot personality changes? Well, first of all, what is a personality change? It's all based on relative strength. A stock that has been outperforming the market like SunEdison starts to underperform the market, so it goes from green to red, has undergone a bearish personality change. And the reason it's so important to spot these is that we tend to be stubborn as traders or investors. And we put our feet in cement. And the worst thing you can do on Wall Street is to put your feet in cement, to not be flexible enough to change your opinion on a stock, bullish or bearish. So here's an example of a bullish personality change. Again, it's in one of those defensive groups that led the market from July through early February. Laclede Group, gas distributor, power gauge had been bullish, went from bullish to neutral and back again. But look what happened in July when the stock started outperforming the market. You start getting some positive money flow and positive price performance. The stock goes from 54 to 66 in a market that's gone nowhere, and it still has a 3% yield. It had a 3.3% or 3.4% yield back in July. Now here's a stock that had a bearish personality change, Union Pacific, one of the great railroads in America. The same chart would show up for Kansas City Southern, CSX, Norfolk and Southern. The rails are hurting because we're not moving a lot of coal or oil products around the country, and that's basically what they depend on for their traffic. Some goods and services, but it's mostly moving energy-related products around the country. And that's why one of the strengths of America is our railroad system. But wouldn't you have liked to have been alerted to the fact back in March and May that the power gauge rating and the relative strength were both bearish? The stock in May was trading at 100 on its way to 67. And if you follow this methodology, you're going to be selling the stock or looking for opportunities to buy puts or go short if you're a trader, but you're not going to get caught in that downdraft. Now, both of those are historic examples, although they're very recent. Here's a stock that's just started underperforming the market, Visa. Power gauge rating has fluctuated from bearish to bullish and back again, but now we've got a bearish rating with relative strength just turning negative, and we had a relative strength breakdown signal coming into today. The stock was down earlier today at 1.5%. I think it did worse by the close because these charts were taken early this morning. The key is spotting these personality changes, and we give you the tools to do that. Now, we have a technique that we've been teaching institutional investors for the last 30 years, and it's based on Chaikin Money Flow. The key to this concept is that big institutional investors like BlackRock or Fidelity or T. Rowe Price have such large positions that they can't get in or out of them on any given day. And they're paranoid. The traders at these firms are paranoid, and so are the portfolio managers. They don't want the hedge funds to know what they're doing because the hedge funds will take advantage of that. So there's a pattern called stealth buying and selling, and it really is a very profitable pattern. And along with that comes one of the real secrets that we've taught our institutional clients along the way. We have some institutional clients here at Chaikin Analytics, but our focus is on the individual investor, giving you the tools that I created for institutions for over 25 years. So here we go. A company called Red Hat. They make open source Unix software. What does that mean? They don't charge for it. So they're competing with Oracle. And notice that area that I mark as heavy accumulation. Institutions were buying the stock aggressively, and then it sold off and triggered what we call an oversold buy signal. Now that's a really simple signal. The power gauge has to be bullish, and the stock has to get oversold and make a new 8-day low. I owe this to a gentleman named Larry Williams, who has been an inspiration to me from the day I started doing technical research. And he's still going strong today, although his biggest claim to fame now is his daughter Michelle, who's won an Academy Award and played Marilyn Monroe and a terrific actress. And she actually won the World Trading Championship using her father's techniques when she was 16 years old. So multi-talented woman. But the key here is when a stock gets oversold and triggers a buy signal and Chaikin Money Flow is green, not red, you can confidently buy that for a trade. Now, bookending that buy signal are two really interesting patterns. Let's look at the one on the right. We often get asked, as I said, how do we get out of these stocks that Chaikin has gotten us into? Well, one of the patterns that will surface more often than you'd expect occurs when a stock makes a new high and Chaikin Money Flow stays red, doesn't go green. What does that tell us? It tells us that the institutions are selling the stock under cover of strength. It's usually individual investors buying at that point, and it's a great place for you to be selling as well. So a new high in the stock with negative Chaikin Money Flow is a sell signal. Now, if you look back in July and August, you had a very similar pattern. New highs in late June and in July and into early August, and Chaikin Money Flow stayed red. Great opportunity to sell the stock ahead of that waterfall decline from 80 all the way down to 66 at the August lows. So this is a sort of secret pattern that we've taught Wall Street professionals for 30 years, and now you can use it. By the way, Chaikin Money Flow is available on stockcharts.com, which is the largest charting service on the internet. Some of their charts are free, and they feature Chaikin Money Flow. So you can get this on any online brokerage platform, whether you're using Thinkorswim or Schwab or Options House. The money flow is there, and you can find these patterns. Now, here's a recent example of a stock with stealth distribution. We started out by talking about that. So what do we mean? Well, Nordstrom's, which is a great retailer but hasn't been a very good stock, had a series of rallies in the summer, but Chaikin Money Flow stayed negative. We call that stealth distribution. The institutions were taking advantage of that strength to sell the stock. So this is a corollary to the previous pattern. If a stock gets overbought near that upper volatility band and Chaikin Money Flow stays negative, that's also a sell signal. Now we've got a big red arrow on the chart because right ahead of earnings, a different signal, we have reversal buys and sells up here, a different signal, one of our money flow signals triggered, and we actually put out a bearish recommendation on Nordstrom's ahead of that November earnings report when the stock reacted to a disappointing earnings report by dropping from 62 all the way to 50. And after a small rally, it continued to go down to 45. So earnings season can be pretty brutal if you're not on the right side of a stock, but look at the Chaikin Power Gauge rating. I called it your GPS during earnings season. If the Power Gauge rating is bearish, that stock is twice as likely to report a negative earnings surprise as a stock with a bullish Power Gauge rating. That's important information. It can help you sidestep trouble or turn that to your advantage. I call it turning lemons into lemonade by buying put options on a stock like Nordstrom. And finally, Twitter. We all love using it, or most of us do, but it's been a terrible stock. They had a negative earnings surprise back in April, came out of the blue. Wall Street wasn't expecting it, although our power gauge was neutral. Why was it neutral? Because Twitter doesn't really make any money. And those fundamental metrics that the value investors use penalize the rating for that type of stock. After the negative earnings surprise, when the stock gapped down from 50 to 35, it went sideways for 3 months. Wall Street was waiting for the next earnings report. And I could have told you, based on a bearish power gauge rating and negative relative strength and all that selling from the institutions, where money flow stayed negative in that whole 3-month pattern, that the likelihood was that there would be a negative earnings surprise. And sure enough, in late July, 3 months later, negative stock goes down and makes another new low. And it's continued to make new lows ever since. Management upheaval, change in command hasn't really helped the stock. Today it was down 3%. Again, it had a nice little rally from 15 to 20. The power gauge will help you avoid getting seduced by that rally. On Wall Street, we call it getting sucked in, like a vacuum cleaner. Negative relative strength, negative power gauge rating, institutional selling. You don't want to be a bottom fisher. Bottom fishing can be a very dangerous game when there are piranhas at the bottom of the lake. So we talked about Chaikin buy and sell signals being the sweet spot of that pyramid. 6 pairs, we've looked at some of them, and they sort of feed into the theme of a disciplined methodology. So to trade more profitably, follow the signals. So here's an example of another defensive stock, Verizon, where the power gauge turned bullish in early January, and shortly thereafter it triggered what we call a relative strength buy signal. You want to follow those signals because it's a disciplined approach to trading, and any decisions that you make based on discipline as opposed to emotions are going to give you an edge. And they should also give you conviction to pull the trigger. How many people on the webinar have experienced the perfect setup and not pulled the trigger and then kicked themselves because they missed out on a great trade? Type a big K in the question box, please, if you've experienced that. I know I did, again, before I built this whole methodology, the Chaikin way, if you will. So that's an example of a buy signal. Here's a sell signal that would have been nice to follow. Macy's. Power gauge turned bearish in July. Started underperforming the market in August. It was trading above $60, and then we had a couple of sell signals. And if you had followed those sell signals, particularly the one ahead of that October earnings report, and Macy's reported it 2 days before Nordstrom's, by the way. So you had a clue before Nordstrom reported that retail sales were not robust. And that sell signal in Macy's was very profitable. We featured that as our bearish stock of the week, and we also did it again, expecting that there would be another negative earnings surprise in February. But by hook or by crook, Macy's found a way to report positive earnings, better than Wall Street was expecting, growth that nobody anticipated. And that bearish recommendation didn't work. Not all these signals work. They work about 2 out of 3 times. So don't expect these methodologies to work all the time. But interestingly, after spiking up based on that earnings report, Macy's has had a tough time really gaining traction. It's gotten overbought. It's still underperforming the market, and they may not be out of the woods yet. So again, how do you find these alerts? Well, in our iPad app, we have a dashboard. In the desktop, we have a little bell that you click to get the alerts. And we encourage you to create a list called My Stocks, which is a great discipline to follow a small group of stocks get to know them very well. I follow a lot of stocks because I do webinars and write a market letter. But the bottom line is, on January 28th, on my dashboard for my stocks list, and we generate this for any list or ETF or index in the system, Amazon gave a money flow sell signal at $583. And Amazon was due to report earnings in a couple of weeks. The power gauge had turned bearish on January 11th, 2 weeks ahead of earnings. And there's that money flow sell signal. This is also an overbought sell signal at the same time. Notice what I was referring to earlier about relative strength standing alone. All the way up, Amazon had a neutral rating. Why? Because here again, they make very little money, especially if you use GAAP accounting and take into account stock options that they're granting to employees. They're buying market share with inexpensive shipping. We all love that, free shipping, or Amazon Prime, $70 a year, and then it's free. But the bottom line is Amazon started to break down, and here's that pattern again. How could you have known that it was urgent to get out of Amazon? Well, when Amazon made a new all-time high back in December, look at the Chaikin Money Flow. It was red, not green, reinforcing this concept that money flow does an effective job of measuring institutional buying and selling. And then about 2 weeks later, the power gauge turned bearish. Amazon was around 600. And right before earnings came out, we said buy puts on Amazon ahead of Thursday's earnings report. Now, something very interesting happened. Amazon rallied from 590 to 635 the day that earnings were due out. And here's a screenshot from CNBC that shows what happened in the minutes after Amazon reported an earnings miss, a negative earnings surprise. The stock dropped from 635 all the way down to 561. It dropped 75 points, 13%, and then kept going lower. But what's interesting is it rallied into the earnings, but we were on top of it, and the power gauge was our guide along with the negative money flow. So that stock dropped from 635 all the way down to 470 before it finally regrouped, and with some short covering and some wishful thinking on this rally in the market, has retraced some of that decline. But the key is that we said in our weekly Market Insights newsletter that with the market likely to sustain the rally for a few more days, use strength above 610 to buy put options on Amazon. Amazon reports earnings after the close on Thursday. Now, this was before we introduced this earnings functionality. Now you can know as much about earnings as I do looking at back then at 2 or 3 different sources. Now I don't have to go to Yahoo Finance or Street.com to find out when companies are going to report. It's all in one place, right on the chart in any of your lists. So we got this testimonial. I'm up over $17,000 in 2 weeks. You changed my life. I'm up over $17,000 just with my options trades on Google, Amazon, and Priceline. It's all from checking the power gauge rating. Chaikin Analytics is a godsend. And we got this testimonial right after the earnings report on February 3rd. Now here's a current example of a stock that disappointed Wall Street. Shake Shack. Danny Meyer is a great restaurateur. He hit it big with the hamburger concept. He's getting a premium price for basically selling beef on a bun, as someone on CNBC said today. But Wall Street has soured on this stock. After it went public in January of 15, the stock had a huge run from 30 all the way to 90 and change. And along the way, there was a positive earnings surprise. But subsequent to that, positive earnings surprises were used by institutional investors to sell the stock because they knew it was overvalued. Once we had 12 months of data in late January, which is what we need to compute the power gauge rating, guess what? Power gauge rating turned bearish. It had been underperforming the market. You can see that, down from 90 all the way to 30. And today they reported positive earnings surprise, or I guess yesterday after the close, but they guided lower. So they reported a penny better than expected, 8 cents a share. This is for a stock that's selling at 40 bucks. So very rich valuations, but they said, we're not so sure about where this hamburger trend is going, and guess what? The stock was down over 10% today. It's what shows you what can happen when the power gauge rating is bearish and a stock is underperforming the market. Even a positive earnings report, albeit one associated with negative guidance, can see a stock down 10%. That's why it's so important to use this new earnings functionality.
Hey, Mark.
Yeah, Joe.
So I'm going through a lot of questions that are coming through, and we're providing some responses. And I see some of our subscribers are on the line right now. Harry here mentioned that he traded earnings on Priceline back in February. He said he was able to sell his calls for a profit of $63,000 for his February 16th.
Wow, Harry, that's just great. And I'm open to a dinner invitation anytime you're in Philadelphia. But seriously, that's a great trade, and hats off to you, and thank you for sharing that with everybody. So before we get into specific examples of how to make money during earnings season and the new earnings functionality, I'd like to get into this concept of defense. Because as I said in the beginning, too many people focus on offense, and it's really good defense that wins football games. When my wife and I moved back to Philadelphia in 2006, the Eagles were a pretty powerful football team. I think they made it to the Super Bowl, and part of the reason is they had a great defensive coordinator, Jim Johnson. Sadly, Jim Johnson died of cancer in 2008, and the Eagles have basically been a disaster ever since because he had a great defense. So in Wall Street, a friend of mine, Herb Greenberg, who used to write for TheStreet.com and for CNBC, penned a column in January of 2014 where he said it's the stocks you don't own that matter. Now, what did he mean by that? He meant that too much attention is paid to finding the big winners and not enough attention is paid to eliminating or avoiding those stocks like Kinder Morgan or Union Pacific that can destroy your portfolio. So let's just quickly look at 3 examples. Wynn Resorts was our poster child before Kinder Morgan for a stock you didn't want to own. The power gauge went bearish about 18 months ago at $195, and I've circled this area in June, July, and August on the chart. When it got down to 100, a lot of the pundits on CNBC were saying, well, maybe it's time to look at the casino stocks. Macau is getting better, where Wynn has a lot of exposure to one casino and a new one that they're building. Well, maybes aren't good enough in Wall Street. Maybes lead to disasters. Power gauge was bearish. Relative strength was negative, and look at the institutional selling. So did you want to step in and bottom fish between 90 and 100 on Wynn? I don't think so. I certainly wouldn't do it. Now, Warren Buffett has famously said that they don't call balls and strikes on Wall Street. Therefore, you don't have to swing at every pitch. So this is clearly a pitch that Warren Buffett wouldn't swing at. Bearish power gauge, underperforming the market, negative money flow. Now we've had a little bit of change. Macau is actually reporting better Chinese tourism traffic. And the power gauge has gone neutral for the first time in almost 2 years. And Wynn is outperforming the market. So very often, especially with this energy bear market we've been in, I get asked by our clients or prospects when I'm up in New York pitching some money managers on the product, well, when will I know to buy the energy stocks? Or when will I know to buy a stock like Wynn Resorts? The answer is, even if the model is neutral, if it starts outperforming the market with positive money flow, that's your clue. That's your early warning that it's broken out of the base for real, not one of these fake out rallies. And sure enough, we had a relative strength breakout signal the other day at 70, and the stock went all the way to 86. Part of the reason is there's a big short position in Wynn, and the short's covered. But there's an example of how relative strength can help you know that the time is right to do a little bottom fishing or to close out your bearish positions. Tesla is another stock that's had a bearish power gauge rating and underperforming the market since early October when it had a bearish personality change. Market agrees with the model on the downside. You get price movement that really decelerates. Massive selling down into the bottom in February or on February 11th. So I don't know if you're comfortable with it, but I'm certainly not comfortable riding a stock from 240 down to 140. I don't care what you've got going in electric batteries or driverless cars or electric cars. That's all down the road. We don't know if Tesla's going to be the winner there. Elon Musk, I've famously called the P.T. Barnum of Wall Street. I've been chided by some of my own employees. You don't want to be on the wrong side of Elon Musk. Well, if you're in Solar City or Tesla, I don't care how charismatic he is and how many rockets he's launched into space. Watching a stock go from 280 to 140 is no fun, and the power gauge rating would have gotten you out in the 240 area. Now, can a stock like this rally? Of course it can. It's highly volatile, and the hopes and dreams of Wall Street are endless. That's what Wall Street's all about. It's about hopes and dreams for the future. So the stock has now rallied 60 points. For those of you who follow Fibonacci, that's a 618 retracement. It's running into resistance here. Is this a stock I'd like to own? Absolutely not. Why? Because they don't make any money. And it's selling at 7 times revenue. Price to sales is one of our factors, probably the most important fundamental factor in the model. You pay too much for $1 of revenue, you're on a high wire without a safety net. And as soon as Wall Street sours on your concept or your stock or you believes that you're not going to deliver 50,000 cars this quarter, you're only going to deliver 30,000. And by the way, Elon Musk will always tell you he's going to deliver at the high end, and for the last 2 quarters he's produced at the low end. So be careful. These guys are on CNBC hyping their own stock. You've got to be careful and have an independent guide. And then finally, a third stock that you didn't want to own in 2015, Intercept Pharmaceutical. Back there at the top, it had a $10 billion market cap in the drug group. Power gauge turned bearish in mid-May. The stock was around 240, 250. Relative strength waited until August to turn bearish. The stock was still in that 240 range. And it's traded all the way down to $82, $84. Today, after it rallied up, it was down another 4%. So these are toxic stocks, and we're not even in a bear market. In a bear market, stocks like this go to $2. I've lived through 10 of them, and I can tell you that reality is suspended, and good stocks in 1969-70 and 1973-4 with names many of you would recognize like Eastman Kodak, IBM, Avon, Xerox, sold down 90% from their highs. Were these companies going out of business? No, but panic sets in and there are no buyers, and that's what happens on Wall Street. So now let's get to earnings season. This is my favorite part of the webinar. How do you profit during earnings season? January, April, July, and October and beyond. Well, there's those 3 factors we talked about. Volatility equals opportunity, and we know that there's plenty of volatility during earnings season. The speculation in the media is something that you've got to ignore. It's noise, it's a distraction, and you've got to focus on which stocks are likely to beat, miss, or meet estimates. And the power gauge is the way you can do it. So let's look at some examples of that, and then we'll show you the new functionality and how that feeds into this. So here's Michael Kors, apparel manufacturer, good brand, pretty much unloved since May when they reported a negative earnings surprise. It happens to be one of the 20 stocks that's in the first series unit investment trust that First Trust created using the Chaikin methodology. Right before the earnings and after it got put in that portfolio in December, there was an oversold buy signal. 8-day low with a bullish power gauge rating. 2 weeks later, they reported a positive earnings surprise. Everybody on Wall Street was leaning the wrong way. They were on the wrong side of the boat. So the sailor captaining the boat tacked and the boom went over and they just fell overboard because they were short the stock or out of it, and it gapped up based on the positive earnings report. If you were following the Chaikin power gauge rating, you would have either been in the stock or watching it, waiting for indication to buy, and it's just kept going. 4 weeks now of outperformance. It was under 40 when they reported the positive earnings surprise. It peaked at 57.50 just the other day, and this is a stock that in their next earnings report is likely to report another positive earnings surprises. These things, as you'll see in a moment, tend to follow one another. There's never just one earnings surprise. Now, we got this testimonial for a chart that I'm going to show you in a moment. I could have saved $18,000. I was at your booth in San Antonio in October of 2015. We exhibited at the Invest Like a Monster conference. John Najarian and his brother Pete sponsor a few times a year. My wife Sandy was actually the speaker, so I was the booth boy. They decided that Sandy does a very effective job of communicating her experience and her profitable experience using Chaikin. Someone came into the booth and asked us to put up the symbol FTNT, Fortinet. It's a security firm that makes network security. There's a big focus on internet security, and Fortinet is one of those companies in that business. The software said sell, but I was a firm believer that it was going up, and I bought calls instead. Had I listened, I could have saved $18,000. This is an example of putting your feet in cement. This is an example of not having an independent third-party objective research capability. So here's what happened to Fortinet from October. It dropped from above 40 to under 25. Almost a 50% drop from the high. So that gentleman, who's now a Chaikin subscriber, could have saved himself a lot of money, but he could have actually come out ahead because we made Fortinet our bearish stock of the week on January 31st. The stock was around $27. They were due to report earnings on Thursday, and based on the bearish power gauge rating and the fact that they had had a previous surprise, I made it my bearish stock of the week. Now, the company reported what looked like decent earnings, and in the aftermarket, it actually traded as high as 31 after they reported earnings. But by the time the stock opened on Thursday, it was already trading down, and it finished the week at 28. And we try to follow up these recommendations. So the following week, we said, stay with it. An overbought sell signal was triggered based on Friday's rally, and Chaikin Money Flow is negative. Stay with the short. Use a closing stop of 31. The stock traded all the way down to 23 before it bottomed out and rallied back up. So it turned into a very profitable position as a put trade. Now here are two more examples of stocks with bearish power gauge ratings that disappointed. In each case, we had a sell signal ahead of the earnings. We featured both LinkedIn and the next stock, Tableau, in a list of stocks to sell ahead of earnings. And obviously, this is an ideal put candidate with that bearish money flow. LinkedIn reported disappointing earnings, and the stock dropped from 200 to 100. Now, if you're a Motley Fool subscriber, you know that they love LinkedIn, and they're never going to put out a sell recommendation. How do I know that? Because I had lunch with Tom Gardner 3 years ago, trying to encourage him to do a partnership with Chaikin. And we were talking about LinkedIn, and he said, we'll never sell it. It's like Amazon or Apple. We've never put out a sell recommendation after our initial buy. Well, I don't know about you, but 250 down to 100, that's a lot of pain. It's pain and suffering and sleepless nights. And look at the money flow. Negative money flow, negative relative strength. Power gauge rating is negative, telling you that the likelihood is that there's a bearish earnings surprise coming, and sure enough, you get it. Tableau, one of those big data companies. Very similar. Sell signal came a couple of weeks ahead of the earnings report. Power gauge had been bearish since August, underperforming the market since August. They disappointed, and same day that LinkedIn, they also dropped 50%. Now, here's a little tip. This is sort of Wall Street Wisdom 101. Anytime a stock has two different concepts attached to it, run the other way. So Tableau is what they call a cloud computing stock, and it's a big data stock. Two big concepts, too big buzzwords, too big to fail. You don't want to be in stocks like that. Concepts come and ads come and go, just like on 7th Avenue in New York, the fashion business. You don't want to be in a stock that's got two concepts attached to it. That's why I think Tesla's a problem. Electric cars, driverless cars, two concepts, too big to fail, too big to handle from my perspective. So based on those recommendations, we got gains of 70% and 115%. I've been using Chaikin Analytics for several weeks, closed out 2 trades for gains of 70 and 115%. Over the years, I've tried different software packages. Chaikin Analytics is by far the most straightforward and productive product I've ever used. And thank you, Eric. So let's look at the big news at Chaikin, which was our release at the end of February. We tend to have a release at the end of every month with new functionality. And the big news was the earnings features that we incorporated into the product. So here's a really good example of that. On our desktop, we've got a list manager that runs down the side of the chart. And in one of our hot lists called Bullish Earnings Surprises, we saw BITA, which reported earnings before the opening today. Now, you would have known that on the chart because we've got a little sun that tells you they're going to report before the opening. And our earnings surprise factor from our model was bullish. Now, what does that mean? It means that they had reported positive earnings surprises in the previous few quarters. And sure enough, they did it again. They reported this morning before the opening a positive earnings surprise, and the stock was up 6% on a day when the market was down 1.2% in the S&P 500. So here's an example of the drill down detail you can get from the earnings features that we've incorporated into the product. Now, one of the really powerful things we do is we put the earnings date on the chart. So here's a stock called American Woodmark. They're the third largest manufacturer of kitchen cabinets in America. My wife, Sandy, has bought this stock numerous times based on the power gauge rating and the relative strength, although she's now sold her stock because the money flow and the relative strength have broken down. But you see on this one-year chart each of the 4 earnings dates highlighted, and that EPS icon is either red, gray, or green, depending on whether the stock reported a positive or a negative earnings surprise. So you see this pattern of earnings surprises leading to big up moves in the stock. Now, that was all well and good when the stock was outperforming the market. They just reported another positive earnings surprise, but this stock has been underperforming the market, and this is a pattern that has just become apparent now that we've put this functionality into the system. Even when you get a positive earnings surprise, very often when a stock is underperforming the market, the price doesn't react the way you'd like it to. So at the top of the chart, you've got the next earnings date. If it just reported, it'll tell you that. You can swipe over it and see the detail and swipe over any of these. Now, you can also look at it on a 5-year chart. And here's where you begin to see the power of earnings reports, not just for trading, but for investing. Back in 2013 and 14, American Woodmark had a series of negative earnings surprises. And the stock sold down from above 30 to 20, underperforming the market. And then in mid-14, they reported a positive earnings surprise. The stock was trading at about 33, and then there was a string of positive earnings surprises. The stock traded all the way up to 88. This is not an outlier. This happens over and over again. Someone once said earnings surprises are like cockroaches. There's never just one of them. And here's an example of that. And now a second example of that. Southwest Airlines was one of the stocks that we mentioned many, many times in our weekly market letter. I think I made it my bullish stock of the week 3 different times in 2014. Starting in late 2013, as the price of oil was starting to peak, Southwest Air had a string of positive earnings surprises. The stock went from $13 all the way to 50. And now you're starting to see a couple of gray bars there, which indicate that they're just meeting analyst estimates, and the stock looks a little bit top heavy here. But the key is that if you're an investor looking for stocks to hold for the long term, there's nothing better than stocks with a bullish power gauge rating that are reporting positive earnings surprises. That whole pattern of analysts raising their estimates and following each other like sheep takes over. If you're a swing trader, these are the best swing trading stocks in the world. Why? Because there's no selling pressure. The sellers get absorbed early, and these stocks can make new highs very, very easily. So another thing that you can do with this new earnings functionality is to swipe over and get a pop-up that shows you details about the upcoming earnings. So here's a stock called, I can't even pronounce it, Excel Service Holdings, EXLS. Due to report on Thursday, May 5th. The estimate is for 46 cents a share. Last year they reported 33 cents, so that's going to be a pretty big quarter. And it tells you that the last time they reported 49 cents and what the revenue was. And you can see on the screen that the last 3 earnings reports have been positive earnings surprises. There's a lot of positive money flow here. The power gauge is bullish. Coming into that May report, you want to look for a buying opportunity. Here's a stock that made a new high today with the market down. It's a stock you want to be buying on weakness. No need to pay up for the stock, but ahead of that May 5th earnings report, having just reported a blowout quarter here in February, you want to be looking to buy the stock, and that alert will be up there in your face, so you're not going to miss it if you put this in one of your watch lists. Now, another thing we do is to enable you to look at a list that we call bullish or bearish estimate revisions. And in this case, we're looking at companies where analysts have been lowering their estimates. And now, why is this important? Well, I've moused over Joy Global, which unfortunately is suffering from the lack of drilling activity. They make drilling equipment. And here's a stock that reported last Thursday, disappointing, 192% drop from a year ago. Revenues dropped 29%, and they disappointed Wall Street. So what happens? Wall Street starts lowering their earnings estimates. You can mouse over. The EPS has a big red exclamation point next to it. That means that there's negative earnings alert. And the stock was down 6% today. So it's important to know which stocks the analysts are lowering or raising their estimates on. We got a testimonial as soon as we release this at the end of February. I'm blown away by your earnings update. It's the best I've ever seen. Thank you. So one final screen which combines our stock screener, which we've talked about, with the earnings functionality. In about 5 seconds, I looked at all 5,000 stocks in Chaikin that had bearish ratings that were due to report earnings within the next 5 days. And earnings season, there were only about 13 stocks that qualified. During earnings season, you're going to find many more names. You can refine them with the other factors in the screener, but here are 13 stocks, including FactSet Research and Buckle, which is, I believe, a clothing retailer, that are due to report earnings this week that have bearish power gauge ratings. Very important information. And interestingly, I see symbol ONCE was down 10%. They probably reported today. Most of these stocks were down. That's the whole point. Stock rating that are due to report earnings are likely to be dangerous stocks to hold. So now that you know the 5 keys to conquering earnings season and making money, taking advantage of volatility instead of being spooked by it, how do you benefit from it? Well, Chaikin Analytics now includes our stock screener, our options play module, which we didn't get into on this webinar, and earnings alerts. It's really a complete package. We got this testimonial saying, "Thank you for making my life easier. I'm writing to tell you how absolutely incredible Chaikin Analytics has become. It started great, but with the options and screener additions, I feel it's absolutely the best product on the market. And now with the earnings alerts, I'm sure JD is even happier." So one final example, and then we're going to give you a special offer. We recommended Yelp where that red arrow is as our bearish stock of the week. Why? Because the previous quarter they had reported a negative earnings surprise, and you can't see it on the chart, but there was a gap down, and it had happened 3 months earlier as well. The stock spiked down about 35%, and we got this testimonial. Netted $17,000 in profit this morning. I've found more success in the past 2 weeks using Chaikin than I've had the rest of the year. Mike T. And Mike T is a sophisticated options trader, but with our new options play module, which generates ideas based on the power gauge rating, you don't have to be an expert. You can find put trades like Yelp. So Chaikin Analytics for both desktop and iPad is normally $1,950 a year. As a webinar special, we're reducing the price by $200 to $1,750. This offer is good until Friday, midnight, March 11th. Go to chaikinanalytics.com/earnings or contact sales@chaikinanalytics.com or the phone number that's on your screen. Now, what do you get with Chaikin Analytics? Well, you get to turbocharge your profits. Oops, we're running into that very interesting glitch. You get the weekly market insights, John Schlitz's daily market insights, so you don't have to be glued to CNBC before the opening to know what the markets did overseas or overnight in the futures. And most importantly, you get onboarding. The day you subscribe, you'll get an email asking you to join an onboarding session, which Joe Bicella and his team head up. And that's the reason that GC gave us this testimonial. In the 5 business days that I've been using Chaikin Analytics, I've paid for the subscription over tenfold. These initial results are nothing short of astounding. Please extend my thanks to the entire Chaikin team. And this really is a team effort. I'm just the spokesperson here. I'm the guy with his name on the door who created the product. But guys like Joe Bicella, our marketing department, our sales team, are all committed to your success. And that's why so many of our subscribers get up and running so quickly and start experiencing the benefits of Chaikin Analytics. Now, to make this even more attractive, we've got a fast action bonus for you. If you subscribe by midnight tonight, we'll take an additional $100 off the price of Chaikin Analytics, reducing the cost to $1,650. And as a special bonus, for the first 7, well, it's March 8th, let's make it the first 8 people who subscribe by midnight tonight, you'll get a one-on-one phone session with me after you've been onboarded by Joe and his team. So all we ask is that you learn the system sufficiently that we can have a rich conversation. We stop short of making specific recommendations. I've enjoyed these phone calls. Our new clients have really benefited from them. We can talk about the market, option strategies, what you do, what you're experiencing in the way of difficulty. So the first 8 people who subscribe by midnight tonight will get this special bonus of a one-on-one phone call. They typically go from half hour to 45 minutes. As I said, I'm getting a lot out of them, and our new subscribers are as well. So I hope you'll take advantage of this. I see 2 people have already subscribed, so if you like that special bonus, take advantage of it quickly. And with that, I'd like to thank everybody for staying with us. Almost nobody dropped off the webinar, which is always a source of great pride for me and for everybody in the company, because we think we're here to educate and help you make money. And with that, I'll turn it back to Joe Bicella, who's going to wrap up the webinar.
All right. Thank you very much, Mark. Thank you, everyone, for attending. I know we received a couple hundred questions throughout our session. I think we got to a lot of them, though I know there was a few we weren't able to answer. However, I know the contact information for our sales team is available on the screen right now. So if you want to give us a call, they'll be able to help you out for any kind of lingering questions that are out there. Of course, as a reminder, this session has been recorded. So if you want to check out a recording of our session, please just make sure to check your email tomorrow morning and we'll have a copy sent out to you. With that said, thank you very much. Have a pleasant evening and we'll catch you next time.